children of planet Earth. Hello from the children of planet Earth, Hello from the children of planet Hello from the children of planet Hello from the children of planet
What's up, everybody? Good morning. Let's get ready to get started. FOMC day. Got 5 minutes to market opens. How you guys doing? You ready to roll? All right. Let's investigate what we have at the open. We have markets trading futures inside of DD bands, right? We have Russell, S&P, and Nasdaq. Nasdaq already tapped in the bottom. You see we have a little bit of pre-selling pressure. Market's already going to be a quiet, small open. I'm sorry, small positions today. If I do any kind of trading at all, of course, once you tap the DD band, that run is particularly over, and the DD band float has failed. Obviously, we're going to wake up Take a look at this in the mornings, read the news, see everything, and then when the market opens, you're going to check that DD ratio. It's likely to still be bullish, and when you have a float failure case, which the float is a characteristic of, you see how it doesn't want to touch the bottom. It tries to resist touching the bottom, and once you touch the bottom, trust nothing else that you see. It's short-lived. So any upside today, I'll take what I can get and get out. I'm very cautious. I think we're going to break those intraday highs through the morning till after Fed. So I'm expecting FOMC to dip and come back to where we started. Obviously, VIX futures are pricing in a little bit more volatility than expected. We're still above that triple B, so we're going to have overshooting pivots as well. Not a clean, easy trading day, but I might throw a couple micros at it just to scrape out a few $100 where I call it in the morning, and they're going to return at 2 p.m. to start analyzing, see what's going on in the Fed. I might want to see a nice little dip in the market to go to monthly hedge pressure, and I still might load up on some longer-term positions like some calls or something. I still think the market's going to be nice and bullish for the rest of the quarter and all the way through quarter 3. So ideally, I want to make a trade that this drops to here and here, and we lose all volatility, and this just begins to melt up. We did an analysis yesterday on the commitment traders. The commitment traders report, we show that there is a looming short position that is still hanging on, hasn't even squeezed yet. So if we do end up getting that short squeeze, it's going to be massive for the market, right? And these are things we always talk about every single morning. Clearly, this is just reviewing that. We've had asset managers longing since October of last year. It's been carrying the rally. This is a genuine rally, not a gimmick, not a melt up, not a short squeeze, not anything. This is people piling back into the market. They're not even as long as they've been. I mean, this is 800-something thousand contracts. We've seen before COVID, people were long 1.1 million. I mean, we're not even as long as we've been. So the capacity of people to be long this amount of open interest in futures is not even close. Look where my mouse is at the highs before we crashed in COVID. Very far from there. I mean, we're 2/3 of the way there. So the market can still continue to long and long harder. And that short position that's just sitting here below zero has just started squeezing as of the last couple of weeks. So we just started the short squeeze, literally just a little bit. And if this position, minus 400,000 contracts, was as low as it was when people tried to short COVID, and when that position starts to unwind over quarters of a period, look what happened from June all the way until March. From June 3,000 until March 4,000. The S&P went up 33% as that short squeezed. Imagine from here, okay? Just keep in mind. So this is what we're looking at. We have 1 minute till market opens, so we're gonna take a look at everything. Grain of salt, being FOMC day. I'm going to grab a few micros maybe out the door if I get a good thing to trade off of. I'm gonna see if hopefully resilience comes in nice and clean. I'm not gonna be hitting this too heavy today. All right, you guys, ready to roll? Got a minute left. That VIX is pricing a little higher. Don't know if we're gonna get anything today, but we'll see. Ooh, that's loud. All right, y'all smash that like button while you're waiting here, and let's get ready to get going. All right. Okay, we are opening in a gap down situation. We're looking at resilience is still positive down at the bottom. Let me throw in a couple of micros at the starting, just a quick long right out the door. All right, just a quickie, just some micros. We're gonna trade, hopefully resilience stays positive. I'm gonna trade all the way to the upper end of close to fill the gap and call it. All right, let's see when liquidity map piles in, let's see what we get. Like I said, just running 30, about 7 points from here, so I'm gonna probably be chunking out at 94, give or take. So you can put a little bit of cash in my pocket here. All right, liquidity map BLU, I'm loving it. How you guys doing today? All right, check this S&P looking out here. See what we're doing. Breaking edge pressure, it looks like. So hopefully get something good. Getting ready for camping trip. Awesome, awesome. Everyone smash that like button while you're here, please. Just give it a go. All right, we're going to see if we trade up. Resilience still holding positive. We're still at the bottom of the bull zone. This is great. I do like what I see. I'm not too worried about this at all. Again, trading very small. Not putting in too much just because we're FOMC, right? So hedge pressure breaks, I'd be careful on SPY and QQQ hedge break. So there's QQQ actually, sorry. Let me open up SPY really quick. Let's do liquidity maps. All right, everybody. Bear long up on SPY. Taking a look at that hedge pressure bounce in just a second. Sitting here at the open. Resilience is still looking good. This is likely to be support. And like I said, there's a liquidity pocket in here. I'll take any kind of bounce that moves slightly higher. And we'll see if I get something here. Now, just remember, we're crashing through DD bands on NASDAQ. Always trade very light going into FOMC. You see a little bit of sector rotation. NASDAQ pulling down, Russell pulling up. SPY kind of trading towards its opening price. Nothing too crazy just yet. I want to get some really nice, lovely dips to buy at FOMC. So let me make sure I got everything here. On my chart shown, monthly hedge pressure is, where is monthly hedge? 437, man, that's great. We are still bullish gamma for the month. I do love it. Okay. Looking pretty solid. Now remember, when you trade outside DD bands, automatically, and this isn't automated, when we get our futures data, we'll have this automated. Outside of here, there is one of the lights turns red. We are irrational already. Irrational random means I don't trade at all or trade small if I do. Just a couple micros if I touch anything at all, like that S&P filling its gap would be something I would just put a couple micros on, fill the gap, call it a day. From here, like I said, that's about a 10-point move from 86. So I'll just stick my long up to about 96 and call it. And just sit on the sidelines waiting for FOMC. Clearly, when you see Russell going up and NASDAQ going down, there is just pre-FOMC sector rotating. As NASDAQ is a little overextended, S&P is still nice and healthy, and things are looking good on the Russell. All right. Okay. How y'all doing today? Yeah, we're still working out the kinks and details to get my futures account loaded up here. So one of the things is it's not the connection isn't connected yet. It's still that test account. So they should have that fixed today, and by FOMC I should be able to try out my first trade and see how it goes. DD showing 99. Incredible. Literally incredible. It can't be any more bullish. Yellow res is still at 0. Let's double check. Hold on. Let's make sure we got everything. Hold on. Let me double check some of these things. Let me refresh. Yellow res just now coming on. Let's see what's going on here. Let me make sure that's not like just an error. Let me do NQ res really quick. Let's load those on here. Oh, that looks like it's not calculating. Oh, thanks for saying something. Let me let him know. Actually, MHG res not working. Let's see what we got here on Apple. Yeah, we should have the data. Very odd. So we loaded a new release on the server just now. What is making splinky noises on my computer here? Okay. Interesting. So I'm going to turn off monthly hedge pressure just so I can auto center and see what's going on here. Let me reconnect. Let me see if my... Losing bull zone on Q, so just keep an eyeball out there. Yeah, I don't know what's going on with monthly hedge resilience. So I'm going to see if we can't restart the process on the server. Let's see what we got here. All right. Good deal, good deal. So, yeah, so looking at half gap resilience is still hanging in there on the S&P. Remember, when we go to rational and DD bands, you have to be very cautious in knowing that resilience may have delayed effects. So, and clearly overshoots and things like this. So, resilience stays greater than 10. Let me show you what it looks like on our cheat sheet really quick. When you have resilience is bullish, inside the box, I pivot that we break towards the top of the box. That's my opening scalp. Remember, FOMC, I try to get something, get out of the way, and call it a day. So from here to there, tie break through there is my resilience trade. Clearly with the... Let me just kind of draw like this. So we're going to draw it. If everybody wants to pay attention really quick, take a look at my screen. I'll show you a few things. Okay, so look right here, everybody. First and foremost, when we use our, we're going to talk about resilience. If resilience stays positive, I trade through the box to the top of the box. That's the resilience move. This is a liquidity pocket. We know liquidity pockets push towards the middle already, and it's random from the middle. We also know from our DD trade, our DD trade setup, if I actually load up the cheat sheet and show you what DD looks like, with the DD ratio being bullish, literally almost pegged out, 99. Bull side tap back to bear side is what I likely look to see. So clearly, from here, bull side tap back to bearish. I'm going to say that I'm looking for any break of this to DD to go to there, and then ultimately back down to here. So you can see that essentially, if resilience is greater than 0, or sorry, greater than 10, this is bullish, which is what I'm looking for in an irrational market. Then I'm looking for the market to stabilize through here and trade back. It's like up and then back down. If there's any kind of loss of the open price and we trade lower with a negative resilience, we have a hedge pressure bounce like so. Any break of this falls really far because you have a 437 monthly hedge pressure. So obviously it'd be lovely to have, you know, Fed crash the market and I can load in at lows, but obviously market's still very bullish on the monthly map, so I'm not going to take a bet on the short side here. So essentially I'm taking a scalp from here to there. I'm going to close out all of it. I'm going to sit pretty for Fed and let Fed jiggle the market around. We all good? If DD is 99, it should mean it's extremely bullish. Now I'm having him investigate this because obviously with those not showing anything, it could just be that it's pegged out because it doesn't have that it's missing data. Let me just spot check a couple of stocks. Is Apple in a bull zone? Is Amazon in a bull zone? Neither. Let's do JP Morgan. Actually, let me spot check it this way. Let's just see. It's selected. Let's go through all the bull setups. It could be it. Let's just double check. All right. Okay. All right, everybody. I love this market. It's looking great. My future scalp playing off from open to close. I'm gonna start trimming there. That's a quickie decent little scalp here. All right. So forecast today, FOMC going to raise 25 basis points. Rocket Scooter for win. You know it. You know it, baby. All right. Give me a second. Just fumbling on a few things here, trying to get everything like Let me do some quickie. Let's do a monthly map. I'm gonna kind of map out some things. Now, I believe the market's going to rally through September, October. As you see, the monthly map is there's just deterioration, right? I mean, look at this. I'm extremely happy that the market, I think, hits all-time highs before October. It'd be lovely to see that happen. 470 is not that far away. 480. Look at this melt. It's just melting. Look at the bull side. Now, there's some bear side starting to step in a little bit. But the bull side is just so bullish until there. So you can see that bear side's leaking out, some bear side leaking in. You can see a little bit of a regime change, but overall, this market is looking stupidly bullish. And I really love what I see here. I can't complain. DD being bullish like that. And let me make some judgment calls. Was 480 the highest SPY? What is SPY high? The high of SPY is actually not 480. It is about 480 and some change. VIX doing okay. VIX doing okay. I am liking what I see. All right. Okay, so monthly map, it's completely deteriorating right now. It's fine. Everybody right now, you go down to the bottom of that YouTube stream, click that like button really quick for me. Let's give the algo some love. You know how it works. Every time you click that button, I smile a little bigger on the inside. Or will the Q snap back? I don't know. We're trading below DD band, so absolutely. Today, probably not. Today, market's probably going to jolt around from FOMC, which is fine. You can see how the monthly maps are getting a little weirder now. But even so, that bull side, look how strong that is. Bear side, look how crazy that is. Right? Bear side deteriorating. Oh, is that you? Oh no, it's okay. It's okay. Oh, I was like, I heard TD Ameritrade noises, and I'm like, oh wait, did I sell something? It's okay. I'm always like, what did I didn't do anything. Okay, IWM, let's take a look. Russell, this is these are very bullish monthly maps. This is incredible. I'm excited. I really am. See this market move. Do I pay attention to daily gaps on futures too? No, they don't. They're meaningless. Gaps in the market, gaps in the equities market are based on imbalances between the open and close. Millions of shares create those gaps. The futures market is created by nothing other than an equation that values the futures contract at open called the IOP. There literally is no amount of futures that if it created an imbalance, then you would make a deal out of it. But there's just a calculation that looks at the spread of positions on the bid and ask and calculates where you gap to. So because there's not millions or billions of dollars creating that gap, it's not used as a pivot. Just Nate. Now, traders psychologically use it. I think it doesn't, since it's not a seller buy imbalance that causes that it's not useful as a return trade like you would with the gap in equities, if this makes sense. The Globex runs a calculation before the Globex opens to set the price. It's arbitrarily, not arbitrary, but it's set based on an equation, and that's it. Monthly maps are looking stupidly bullish for the next quarter. It's getting, now again, it's getting a little wobblier, but you can see there's a clear, I mean, they're just melting. That short squeeze I talked about yesterday, we had a whole hour-long conversation about that looming short squeeze. I believe in it more now than ever, seeing these monthly maps switch on. But this price always draw to liquidity or imbalance. So you're correct. So the calculation of IOP is supposed to guess where liquidity is. And the only thing they have to go by is in the pre-market, or I guess the pre-open state on the Globex. You can place limit orders, or certain people can place limit orders. And if you put on the bid or put on the ask, the distribution of positions. If you go to CME website, there's an equation and a video on the equation that tells you how the IOP works. And it's just a math formula that calculates where you price the futures contract at. Now, when it comes to equities where you open on a gap down, for instance, or a gap up, the market makers not only have, a visibility of the level 2 the same way like you would with the IOP and futures, they also have the MOO orders and the MOC orders that they know the actual desire to buy and sell on top of that with orders that must be filled. So they have a little bit more information in equities. The gap is more meaningful because the market maker takes a position to create that gap. They gap down and they're the ones who bought or sold at the other side of that gap. When you gap down in futures, this doesn't happen. The market opens at a price without a trade. Do you follow, Nate? So when the IOP just opens futures at a price with no fill at that price, it will open at a price before a single trade's even made. You'll see that with the VIX. When the VIX opens, sometimes you won't even see a single VIX futures contract, but you'll see a quote, right? So it just opens with a bid and ask before anybody touches anything. There's no imbalance that creates the gap. And so for that, the only reason that gap even makes any sense, and there's no closing imbalance either, right? When futures stop trading, they stop trading. There's no imbalance any market maker would take. So if there's any activity around a gap in the futures and the hour the Globex closes and opens, it's purely psychological because there's no reason for it to provide any volume because there's no volume imbalance there. And again, it's not, like I said, the reason it would do anything is that it's psychological. People will behave there maybe when it returns there. They may fill the gap and sell off. They may fill the gap and load up. Who got the $35 a month? Edward. Yeah, send me a message. Oh, I need to do that on Twitter today. Join the Discord, link below, send me a message. I'll hook you up with the coupon to get your 35. I got you, man. All right, so let's take S&P trading through half gap. Let's see, resilience still negative. I do not like what I see. Ugh. Looks like NASDAQ resilience finally process turning back on. S&P monthly resilience, let's get that going. Do I just want to take some profit on my trade? I don't even know if what do I, 200 bucks. We need that. I'm going to give S&P a couple more minutes. Baby. Let's go. Move to this side of gap. Now, this is not looking good with resilience pulling back. But I do like to see the idea that the VIX is just collapsing right now, going into FOMC, which is great. There's no unexpected behavior. We're going to get 25 basis point, probably a 99% chance that's going to happen. And I hope that the market dips and then rallies back to where we started. All I know is that gap saved you during the 45-day chop in June. I mean, they're targets, right? You set a target and they're psychological. It's just like in an equities gap. If I fill the gap, I usually sell because there was selling that created that gap. So if there's buyers that meet sellers, anytime markets prove liquidity, I usually start trimming out. So anytime you fill a futures gap, it's not necessarily providing liquidity or proving liquidity, right? Where gap down, there was no proof of any buyers or sellers because there were no buyers or sellers that created the gap. So while it is a different thing, it doesn't negate the idea that it could be important just because it's psychological. Importance is set by us. We determine what's important for whatever motives we have as traders. So not a terrible thing to do. The Q snapback. I don't know. I'm looking at the way things are looking today. Pretty excited to see markets stabilizing. Now again, breaking DD band and coming back inside on QQQ, or sorry, on NASDAQ futures. Not the most, not the most stable thing in the world. Let me just kind of mark where that DD band is. Oh, I think I have some drawings already here. About right there. So anything below this green line, just assume there's a red light turned on. Anything above this green line, it's yellow. All right. S&P resilience pulling back, so we might get a nice little dip or sell off today. I'm not too terribly excited about seeing. I mean, not excited about seeing the market dip. Nice little low to grab in for this big rally we can be seeing over the next couple of months. So I'm really excited about it. Now let's just go quick and dirty chit chat about what we're seeing in the economic data. Let's talk about health of the economy, right? These are U.S. job openings. These are jobs that could be filled in a 30-day window. And the jolts are coming down, which typically, if jolts are coming down because people are going back to work, then there's companies on hiring sprees. Or if you create jobs, also jolts will go up. If you fill jobs or eliminate jobs, jolts will go down. So you can have a mixed meaning when they're coming down. So we have to analyze the unemployment data just to see. And the continuing unemployment claims, or continuing jobless claims, people filing for unemployment over multiple periods, not just the initial period, as you see, are also trending down. which does answer the question. It's not that companies are going, well, we had 3 accounting positions, now we only need 1. Let's close 2 of them out and fire those 2 people. It's more like we had 3 and let's fill them back up. So the job is no longer open, available, and it was filled because this is trending down as well. So unemployed people are going back to work. That's a check mark for good economic data. Recession is based on 2 things. Well, actually 1 thing, a decline in economic activity. And the easiest way to see that are 2 very important metrics. Now, you can build a case for that using inflation and credit and lending and borrowing and all the different parts of what can stimulate an economy in the credit cycles. But in the bare bones, what makes a recession happen is slow down economic growth. And the top layer metric of that is your GDP. If you're not making stuff, your GDP is not, you're not producing stuff, or you're producing into a buffer because there's no demand and you're producing a stockpile, so you choose to slow down, you will see that reflected in GDP. Another thing is the labor market, people losing jobs and getting jobs. Companies don't hire people and go on a hiring spree during a recession if they're slowing down. If I run a company, if I'm speeding up, I'm hiring people. We just hired 2 new people this week. So if you're on a hiring spree, you're doing great. You're forecasting 6 months or greater of needing them to produce more stuff for your company, which reflects in GDP. GDP up, that's great. People that were unemployed going back to work, that's great. So first part of that, jolt's coming down because people are going back to work. That's lovely. Initial jobless claims are people that are just getting fired and laid off, and you see waves of layoffs are becoming less severe over the last year. And then we had this last little bump right from January until now. Now, this is when the stock market bounced out and started hanging out. You started losing, people were getting laid off, but now that layoff metric is coming way down. So these are waves of layoffs. Right? People are getting laid off in batches, and then it's slowing down. You're not seeing waves of layoffs getting much larger. Like, COVID had huge amounts of people just getting fired and getting, let go, playing unemployment. But you see, in general, it's just not getting worse. Companies are hiring people back. And this is proof that they're not firing people as well. So if they were firing people, then the jolts would be going down because they were closing the job out and not filling it. So really, companies are holding on to the employees they have and hiring new ones. Check. 1/2 of recession is over, has been done. Okay, let's do the other half. GDP quarter over quarter is still, while it's a slightly declining growth rate, we're just now climbing out of a recession. And from April until November of last year, this is growth rate, right? So quarter over quarter. So as long as this is greater than 0, we have more higher GDP now than we did a quarter ago. These periods of it being negative is your period of slowdown. This is your recession. People were unemployed and getting laid off at the time. So unemployment up, GDP down. That's definition, the closest definition I use of a recession, economic slowdown. Now, I'm not going to go any more textbook than that. This is proof of your slowdown. Lay off people, things slow down, and now things are speeding up. The growth rate is 2%. On this 1.5 forecast, we are beating expectations on growth. Why? The tech industry is booming and hiring people back. This is great utility for proving a good economic case for a bull market. Doesn't mean that the market won't be bearish and credit bubble. Listen, you're going to hear the bears crying for the next 3 years about, well, there's a credit bubble and we're trading 20 times over earnings. Yeah, we all see it. Doesn't matter. See, a trader doesn't sit there and be scared of a long bet because of Chicken Little. What I'm going to wait is for this to go negative or proof of layoffs. And I'm going to look at the commitment of traders to show me that people are selling the market, which they're continuing to long the market. I'm going to look for the evidence and get a weak head start. I might miss the first week of selling, but the trick in a bear market is to see it as it's happening, not predict it as markets are still going higher. Do we all understand? You can't argue with the net long being more long. This is a fact. This is the position of the asset managers. They have been longing since October of last year, and oh boy, the market's been rallying since October of last year. I had some nerd yesterday on Twitter trying to argue with me and said that this wasn't even real data, that this is stupid, and this is where people are positioned. See, supply and demand. If people want to buy something and you own that thing, you're going to raise the price. The more they want to buy, price is going to go up. This is literally like when you open an economics textbook. It's on page one. Not even on page one. It's on the inside of the front fucking cover. Economics is based on the supply and demand of things. The first fucking sentence in your textbook literally is about supply and demand. There's your demand. That's why markets are going up. It's not a short squeeze. It's not a melt up. That's something that chartists do to fill in the void of what charts can't do, which is fucking anything. Charts can't tell you anything about the market other than the history of price. That's it. That's literally all a chart is. This is the history of price. And over a 1 minute period, the chart can't predict anything. It doesn't tell me who's long, who's short, where their option strikes are, how big their positions are, who's trading against who. Are the banks long? Are the asset managers short? It doesn't tell me anything. It just shows me the history of price of a thing. If you want to forecast something, what good is the history? Why not look at where people are positioned now? And how about we look at where they're positioned 3 months from now? To forecast into the future. Let's look into the future. And the idea comes down to the basic principles of why markets rally. There is clear demand for stocks, and people can say, well, it's trading over earning. Doesn't matter. If people out there want to buy stocks and be stupid because it's trading over earnings, they still want to buy. Your job as a trader is to see that they still want to buy. The valuation of something is completely arbitrary. The valuation of anything is based on the rate of exhaustion of the demand imbalance against the supply. As long as people are willing to buy something, it will go up until they're no longer buying. Doesn't matter how many time earnings. And during the last tech bubble in 98, companies traded infinity times over earnings. Companies with literally zero output, zero sales, not even a website, were trading hundreds of dollars a share with zero earnings. Companies at a net loss. Literally dividing by zero is infinity. So the idea is that you can't assess how high above earnings is too high. You know how you know it's too high? When people just no longer want to buy. And you just watch and watch and watch. And as I see, people still want to buy. This bull zone is just deeper and deeper and deeper in the money over October. People can't get into this rally too long fast enough. They will long at any point, any dip inside of here through October. These calls are in the money, are willing to load up and be long in October. Every dip is going to be bought up over the next quarter. That's what people are telling me in their options positions. Bears can't wait to get out of the way. Every single pop, every single week, more and more and more bears are getting out of their trades starting from today. This is what I talked about yesterday. Teach you guys something pretty cool, okay? So when the bull side is getting deeper in bull territory, it means the asset managers are becoming more long the market over that period of time. There are, at this price, people that sold option, even option sellers are going to be forced to long. But basically it means the longs become more long. The asset manager category goes out there and accumulates futures, right? So AM pointing up. When the bear zone is deteriorating like this, it means the hedge funds and the commitment traders are covering. So you have covering, asset managers are longing. Do you all understand? So when you do this kind of prediction, it forecasts that same thing to commitment traders, okay? That blue is about to squeeze as they're covering as the months go by. That green is going to become more green as the months go by. I'm predicting the commitment traders over the next 3 months is going to look like this. And this is what's going to put us on the map. Rocket Scooter monthly map is going to forecast what the commitment traders is going to look like over a 3-month period. Those hedge funds are going to get squeezed like nobody's business, okay? A period of hyperactive illiquidity to the upside. You can see that the bull market is now starting to have concavity change. When you reach that inflection point where your second derivative is 0, you have a convex concave concavity change about here. That's when the short starts squeezing. Short squeezing is a self-catalyzing reaction and becomes parabolic towards the upside. The curvature changing is an acceleration mechanic. If this squeezes even positive like it did here, the S&P goes to 5,000 and further by the end of the year. If a short squeeze happens, people calling this a melt up, these amateur chartists out there, literally, like, listen, don't pay attention to people that post charts. Pay attention to people that trade. Traders don't disagree with the bears. The only thing that makes me better than them is my timing of being bearish. Timing is where you make your money as a trader. Everyone agrees on the same data points. Yeah, QT. Yeah, that's not great. It's not huge bull for the market. But see, here's the thing. It's not the bullish part of the market that's going to push. QE is when the Fed is buying things for their balance sheet. It's not going to be the buying that continues the rally. It's the short that hasn't squeezed yet. It's people exiting a position. And the same thing happened post-COVID. The same thing happened here. Despite asset managers selling, from this point, the market still rallied for 6 months because of the short squeeze. The short squeeze right here carried a rally despite everyone even dumping their shares. As long as there's a willing buyer, even a buyer to exit, markets still go up until you exhaust the buyers. And so I don't need to just sit here and Chicken Little for the last year and then still do it now because of the confirmation bias of trying to short what is. I see people are continuing to bet short against the market, and I agree. Economic data is just slightly improving. It's not like it's amazingly better, but it's better. Fed's not, everybody's saying 5%, 5.5% rates. We're going to go to 6. Well, in bull markets have survived 10, 15% rates before. Rates are not going to change a lot of things when the mechanic is shorts buying in mass to get out of the way because it costs money to be short and they're just getting squeezed. This short squeeze hasn't started yet. Well, one can argue that there's waves of it. Maybe that is the start of it. But you can see the building short in the recession is still getting lower and lower and lower and lower as time goes by. Does this make sense to everybody? Everyone, and again, like people on Twitter that post charts and sell newsletters and stuff, look, that's their job. That's their job to scream something because that's why there's a CNN and a Fox News. Everybody out there is looking for confirmation bias. There are bears out there looking for someone to give them a hug. And these people screaming bear is their teddy bear, which is fine. Like, it is what it is. But, the idea is that your job as a trader is to time what you think is going to happen correctly. I think that we're going to go into a huge credit crisis. I'll be the first one to admit that. I think that losing a period of QE is going to have longer term effects on lending. Now, right now, I'm going to tell you, Nicole and I have been shopping for houses and looking in, major cities we live in the 1 to 2 million range. Houses flip within a week of being on the market. So somebody's loaning people money in the millions to buy houses still. So it's not like you're seeing houses sitting there 30, 60, 90, 120 days out. These fixed up mid-century modern houses that we like, even in the 500 to million range are flipping like crazy. So it's not just the wealthy that are able to get, buy stuff. These are average working families, a married couple, 2 incomes. In Houston typically buys $1 million house. This is pretty normal. And we can't, by the time she texts me and I pull it up, it's already pending. So, you wouldn't see people flipping houses so quickly if there wasn't someone handing out loans for them, right? So when you're trading, you keep your ear to the ground on things to kind of really see how things are going locally. Now, this is a major city, so obviously, and unemployment situation's getting better, so it's less risky to loan out money, and everyone can kind of see that. So I have to take just a moment to just show everybody that positional data is the strongest thing in the world, because it shows you the supply and demand, and there's a tried and true formula. As long as people are willing to buy something, the price goes up, whether they want to long it or cover a short. Longing the market, we rallied after COVID. QT and rate hikes announced, and the asset manager was like, no, I'm going to get out of the way. Sell. But even so, the shorts couldn't hold on anymore. They got squeezed so hard, they were forced to buy to get out of the way, despite knowing there was a recession coming for half a year, which is what we had. GDP shows half a year recession. Well, excluding COVID, which again was another year. And then the short covering. People were buying here. Once the longs stopped and the shorts continued, it keeps going until everyone is selling. And this is the point when everyone is selling. Green is down, blue is down. At this moment in time where my mouse is, both green and blue are down. And guess what? The bear market continued. Let it show you that. God, if I miss the first 2 weeks of a bear market, I'm not going to miss the next year. You will literally see it when it happens. People trying to guess it as it's going up are not real traders. There's no way a smart trader, especially people buying long-term puts against an uptrend. Why not let the market have its first nasty sell-off, wait 2 or 3 weeks, let it recover, get the proof that it's selling, and then buy your long-term puts? I don't understand why people don't do that. Why not see what's in front of your face and understand that asset managers want a long? Who cares why they want a long? As long as they're longing, I'm going to ride the wave. Trading is like surfing. You don't say, well, there's a good wave, but it's probably going to stop. I'm checking the weather conditions, and it looks like the waves are going to stop in an hour. Look, you're going to go out there and ride the waves until they stop coming. Then you're going to go home. What are you trying to do? Save 5 minutes of time by not having fun being part of what is? Don't try too hard. Read the data. Yes, trading 20, 30 times over earnings in some stock. Yeah, 100% correct. Yes, we're in QT. Yes, lending is somewhat tight. Yes, there was a banking crisis. Yes. All these bad things, but still, as long as people are willing to buy, and as long as shorts are willing to cover, markets still go up. And they stop going up when that stops happening. The Rocket Scooter monthly map is designed to forecast when that stops happening. And longs are just getting longer and buying deeper as the months go by. And shorts are just running from the market over the next 3 months. I'll be loading up on September calls. Probably. At some point, October calls. Even at highs. So we'll see how that works. All Papa Bear wants to see is Goldilocks zone. Drop below triple B. August will rally. That's what I feel. As long as we jump through here, August will be a very solid rally month. This is what the Goldilocks zone, where everything's clean. VIX and decay, perfect. You got it? Now again, not investment advice. The point is that as a trader, you need to time things. And that's all you want to do is time your entries. So this is a great resilient market. All right, let's take a look at what we're seeing. Trading at half gap, S&P resilience is still positive. I'm still in my trade, hanging on to this. Just seeing if I get anything. Maybe one more bump up. I'll close right up here. Just a quickie little future scalp. Anyways, I'm excited to see the market move, and I promise you this: I was the first bull of the party. I'm going to be the first bear of the party. I'm going to be at the party. I'm not going to be. I'm not going to be at the party. I'm not going to be at the wrong party, right? I'm not going to show up to the bull party with a bear costume on and make everybody feel awkward. I'm going to let the market show me it's bearish, and those are easy signs to see. And essentially, rocket scooter, commitment traders, all that showing me. I mean, DD being 98%, like that. This is one of the strongest bullish signals we've seen. Nothing about this is showing me any sign of bearishness. All right. Again, I don't disagree with, and people say, but the economics is bad and you're wrong. I'm like, I'm not wrong. I'm reading what the stock market's doing, and the asset managers and the investment groups and fund managers are doing. It's, if anyone's wrong, they're wrong, and that's okay. I'm trading the imbalances. That's my whole job as a trader. It's just to trade what is, and that's all I need to do. I don't want to predict that the wave ends. I'm just gonna let it end and do it that way. Let me see if I have my... Let me try something real quick. Connect something here. Oh, 1 second. Got a couple things I need to do really quick. Gotta test out my futures account here, my Rockscape futures account. Now, hopefully I can get this going today. Trying to log in. All right, connection. purring. All right, S&P still fighting. Still hanging in there. Okay. Oh yeah. So it's weird to see the resilience is pegged out. We're investigating this right now. We have all the monthly hedge pressures. We're just trading above 100% of them. I guess that's basically what it is. This still seems a little odd, but we're investigating that. But the idea that monthly hedge resilience is pegged out, we're not really sure. We just pushed a new release. We're not really right now. We're investigating just the live trading first. Is the immediate first step. All right, everybody. Sorry about that. That volatility decay, I love what I see. I think FOMC is going to be not a big shock. I think market's going to probably dip and return to normal. I think earnings is going to still be the driving catalyst to this market. There's a looming short squeeze, and I can't wait to be part of it. I'm going to trade what is. I'm going to call it a day. Let's come back at noon Central, an hour before Fed, and we'll start doing an FOMC roundup. Talk about what's going on, what I expect to see, some levels, targets, and do even some trades around it. But for right now, market's probably going to sit here and do nothing for the next 3 hours, and basically just going to not sit here and watch paint dry. So we will see you in about 2.5 hours. Come on in. And again, if you need access to anything Rock Scooter, send me a message in Discord. I'll make sure I hook you up with a coupon to get you in at those rates. $35 a month. Try it out. Or if you won the Twitter contest, send me a message as well. I'll make sure I hook you up. All right. let's take a break and we'll reconvene later. Y'all have a good one.